Where we see the most investor conviction is really in markets that have demonstrated demand, especially when that demand has been durable through a lot of the volatility that we've seen in the marketplace. So some areas where we see that is in the residential markets, particularly multifamily. Property fundamentals like occupancy have stabilized, and with the dearth of new supply, we expect rent growth to be more profound in those places relative to Sunbelt markets where maybe the wave of supply hasn't quite played out yet. So the marketplace right now is highly bifurcated in terms of geographic performance, especially in residential. The Sunbelt markets are still dealing with an overhang of new supply in certain markets.
I think that multifamily is really interesting because of the reset in cap rates. So you're seeing right now really attractive multifamily assets trading at a more reasonable cap rate. I think that multifamily, though, because you can buy trophy multifamily at much lower, below replacement costs, and it's going to cost you way more to build it today because of the higher costs of construction financing. I think it's actually very attractive, but you really got to pick the right buildings. I think the pricing around multifamily is probably the most attractive it's been in the last 5 to 10 years.
So we have been advising Japanese capital for about 4 years now that we've aligned them with local operating partners, and they've been making investments into that sector, both value add and development. For our German capital, we have made very small investments in multifamily, but right now I'd say because of, there's a bit of pause right now taking place amongst the German community. Right now I think they'd be interested, but there's just not a lot of liquidity out there to make investments.
We are risk on when it comes to multifamily in select markets. We luckily did not overinvest in the Sun Belt, and we do have dry powder now to invest in some of the regions that are benefiting from a resurgence. So some spots out in the West Coast, and definitely looking in some of the major metros in the Northeast.
From my standpoint, looking at housing, which is what our focus is, in the West, when COVID hit, we had a market that was a 3% vacant market. Rents were going up 4 to 6% a year. Supply and demand was generally in balance, but the historic undersupply across the entire West really put a underpinning of stability within the market. Over the last 5 years, graduates, people coming back in, have refilled effectively the supply or the vacancy in the market. And based on our research, we're seeing is that the markets in the West will regain above 95% occupancy sometime during 25. And so we expect 25 to be the beginning of what we see as a run of rent growth that will be difficult to catch. So we're looking at it, and we think 25 is going to be a good year. We think 26, 27, 28 are going to be exceptional years. And so that's really what we're finding based on our research for the West.